If you have spent any real-time trading with order blocks, you already know the frustration. The issue is not that order blocks do not work. The issue is how these indicators decide what counts as one. Most of them are not applying any real logic. They are scanning for candle patterns and drawing a box. That is it. Here is what I want to show you in this video. There is a free indicator on TradingView, no subscription, no paid tier required, that actually checks for all of that before drawing a single zone. It validates structure. It reads volume. It shows you the imbalance inside each block so you can see at a glance whether a zone has weight behind it. Stick with this until the entry rules, because that is where the real difference shows up. Quick baseline before the indicator. An order block is the candle right before a sharp impulsive move. That is where large participants were positioning, absorbing one side, loading the other. The move that follows proves it. And because that positioning rarely completes in one pass, the level stays active. Price returns and so do they. Bullish order blocks are the last bearish candle before a strong upward impulse. Bearish order blocks are the last bullish candle before a hard drop. What validates either one is the strength of the move that follows. Slow and grinding means nothing happened there. Fast and decisive means it did. Doing this by hand across multiple time frames is where most traders fall apart. You miss zones, misjudge candles, and still cannot tell which blocks actually carry weight. That is what the indicator solves. The indicator is called Order Blocks Volume Delta 3D. You can find it on TradingView for free. Search that exact name and select the one by Flux Charts. It loads directly onto your chart. The first thing you will notice is shaded rectangular zones with percentage values printed inside them. Those percentages are the core of what makes this tool different, and we will get into what they mean shortly. First, let us go through each setting so you understand what you are controlling. Swing length is the first one to adjust. This setting determines what the indicator considers a valid structural move. Keep it low and it reacts to minor swings. More zones appear because smaller price shifts qualify. That can be useful if you are trading on shorter time frames and want more frequent levels to work from. Raise it and the threshold tightens. Only more significant structural moves generate an order block, which means fewer zones, but each one is backed by a cleaner break. Invalidation method controls when a zone gets removed from the chart. The wick setting means that as soon as price touches through the zone, even just the wick, it is gone. The close setting means price has to actually close on the other side before the zone is removed. Which one you use depends on your risk tolerance and how you approach stop placement. There is no universal right answer, but it is worth testing both to see how each one behaves on the assets you trade. Retest labels add a visual marker when price returns to a zone and shows a reaction. This is practical. You are not always watching the chart the moment price taps a level, and having a marker there after the fact lets you review what happened and whether it's set up cleanly. Now, volume delta. This is the feature that sets this indicator apart from most others in this category. Volume delta is the difference between buying volume and selling volume during the candle that formed the order block. If buyers were dominant, the percentage inside the zone will reflect that, something like 60 or 70% on the buy side. If sellers were dominant, you see it skewed the other way. This matters because a bullish order block with 70% buying pressure is structurally different from one sitting at 50%. The first one shows a genuine imbalance. The second one is almost neutral. Buyers were barely in control, which means there is much less reason for that zone to hold on a retest. There is an additional setting here that takes it further. You can choose which time frame the volume data is pulled from. By default, it reads volume from whatever chart you are on, but you can set it to aggregate from a lower time frame instead. The reason to do this is simple. A single candle on your chart is not a single event. A 15-minute candle contains 15 minutes of price action, multiple pushes in different directions, shifting pressure, partial reversals. Reading just the closing volume of that candle compresses all of that into one number. You lose the texture of what actually happened inside it. If you pull volume from the 1-minute time frame instead, the indicator is summing up every one of those individual candles. Every shift in pressure within that 15-minute window gets counted. The resulting percentage is a more granular read of who was actually in control while that order block was forming. Display style is the last main setting. Vertical orientation splits the zone left and right based on bullish versus bearish volume weighting. Horizontal splits it top and bottom instead. The underlying data is identical, it is just how the visual is arranged. Use whatever reads more naturally to you when you are in the middle of a trade. The 3D variant adds depth to the zone appearance, making individual blocks stand out visually when there are several on the chart at once. Purely cosmetic, but it does help with quick visual scanning. You can also configure alerts so you get notified when a new block forms or when a retest occurs. To set these up, go into the indicator settings, select the alert conditions you want, then open the alerts panel on TradingView, point it at the indicator, and create the alert. From that point, you do not need to be watching the chart continuously to catch a setup. Now let us walk through how to trade with this. For a long setup, start on the 4-hour chart. The only thing you are doing here is reading the overall direction. If price is making higher highs and higher lows consistently, the structure is bullish, and that is the bias you work with. That means you are only looking for long entries going forward, not shorts, not anything counter to that trend. From there, go down to the 15-minute. This is where traders often make the mistake of jumping straight into entries. The higher time frame can be clearly bullish while the 15-minute is still dropping or moving sideways. In that case, the time frames are not lined up and the trade does not have proper confirmation behind it. What you need to see is the 15-minute also printing higher highs and higher lows, structure trending in the same direction as the 4-hour. Once both levels agree, you have alignment. With alignment confirmed, find the bullish order block on the 15-minute that is closest to current price and has the highest buying percentage inside it. That combination, proximity and participation, is what makes one zone stand out over another. Higher participation means buyers were genuinely positioned there, which increases the probability they will defend it on a return visit. Then the trade is about patience. You wait for price to pull back into that zone and show a reaction. A bounce off the block tells you buyers are active there. The zone is not just a level on a chart, something is happening at it. For confirmation, look for a bullish candlestick pattern or a momentum signal printing right at the reaction point. Once that lines up with everything else, that is the entry. Stop loss sits below the order block. Take profit targets a 1 to 1.5 or 1 to 2 risk-reward ratio. For a short, run the same process in reverse. On the 4-hour, confirm a downtrend. Lower highs, lower lows, momentum pointing downward. That sets the bearish bias, and from that point you are only looking at short setups. Drop to the 15-minute and confirm the same directional structure there. If the lower time frame is still chopping or grinding up, you wait. When both time frames are trending down together, you have your alignment. Find the bearish order block on the 15-minute that is closest to where price currently is, with the highest selling pressure reading inside it. Let price retrace up into that zone. When it taps the block and shows a rejection, a sharp move back in the downward direction, that is the zone defending itself. Get confirmation from a bearish pattern or signal right at the rejection point, and that is your short entry. Stop loss above the order block. Same risk-reward targets. The framework is intentionally straightforward. The 4-hour tells you which direction to operate in. The 15-minute tells you when the structure on a smaller scale agrees. The volume delta inside the zone tells you whether the level is backed by real positioning or just a shape on a chart. When those three things point to the same trade, the setup has a legitimate basis rather than just a visual one. If this clicked for you, the next thing worth watching is the video on the triple EMA setup. That one covers how to use the 11, 21, and 51 EMAs together to read trend direction, time entries, and set stop levels, all using a single indicator. It pairs well with what you just learned because the order block gives you the zone and the EMA structure gives you the trend context around it. Both together make the decision much cleaner. That video is right here. Go watch it next.